let's hone in on a little bit on sanctions and their impact.
Sure. Well, I think for the tanker sector, the impact so far has been limited. I think in other shipping sectors, they've been a lot more vulnerable, particularly the container ship market, and also dry bulk sectors as well. And that's something we look at MSI across our range of shipping sector analyses and models.
Now, you mentioned flows leading up to 2020 and perhaps a little bit beyond. What, to your mind, are the top 3 trade route changes you expect to see for crude and product tankers?
I think we are going to see this premium on sweet crude as refiners are looking to generate low sulfur fuel. And I think that's going to support trade out of the Atlantic into Asia. I think for the product sector, we're going to see a lot of redistribution, and particularly we're looking at diesel. We're expecting Europe, Singapore to be driving up imports from surplus regions like the US, Middle East and Russia.
Now, a big and ongoing question right now is, what are Iranian VLCCs up to and how will they impact the market?
Yeah, so I think the Iranian question is a result of the sanctions that have been imposed by the US. I think we have seen some build-up in floating storage on Iranian ships as they look to move surplus crude onto vessels. We have seen precedent of this in the past, though, and with previous fluctuations in Iranian exports and floating storage, we haven't seen a huge impact on the tanker sector. So for us, this is a substantial point, but I think the broader question is, what is OPEC going to do in response to the oil price and oil demand in 2019, and will they cut production?
Well, picking up on that, where's the oil price going to be in 12 months' time?
We are expecting it to be broadly stable. I think what you do see is this reaction from OPEC potentially when we see oil prices decline. So we're expecting it to hold around the $70 to $80 per barrel mark. As I mentioned, if we see demand growth falling off substantially in 2019, then that could be a different story. And also the OPEC cuts potentially are going to provide a supportive element to the crude oil price, but we're not sure at the moment the extent or timing or even whether those cuts will happen. They're under discussion, I think, at present.
We've seen a lot of the larger operators in particular invest in scrubber technology in a big way. Frontline, Torm come to mind. Is this trend going to continue?
Yeah, I think we are going to continue to see scrubber investment going through 2019, but I think the extent of scrubber-fitted ships by the time we get to 2020 is still going to be a relatively limited proportion of the fleet. So most of shipping is going to have to rely on compliant fuels being available for non-scrubber-fitted ships. And that's our view, that we're going to see this big increase in compliant fuels. The likelihood is that we are going to see bunker prices elevated as a result of that, regardless of, even if we see a kind of stable crude price.
We've talked about investments in the ongoing fleet, but this morning at the Intertanko breakfast, we heard about recycling. What is your expectation in terms of recycling for the fleets that you cover?
Yeah, well, we've seen this huge increase in scrapping of tanker vessels across types, but particularly concentrated in the crude sector, and we're expecting that the recent levels of scrapping to continue across the near to medium term, and that's partly a factor of regulatory changes, although in the tanker sector we are going to see benefits from the IMO 2020, but it's also just a mechanical effect, if you like, from the ageing fleet, and we do have this build-up of ageing tonnage which hasn't been gotten rid of in previous years. We've seen very low scrapping prior to 2017, so really we've got this latent capacity that needs to be moved out of the fleet, and that's going to support or restrict fleet growth going forward, which we think will support freight rates in the market over the next few years.